keep telling you, this market's turning vicious, at least for the moment. And that means you need to get a little more selective about the stocks you own. You want companies that can thrive even in a time of uncertainty, even if the trade war drags on, even if the political fallout from impeachment makes American businesses gun-shy about spending money. So what might be worth picking at here? Consider some of the better-run fast food chains with stocks that have been holding up pretty well of late. Remember, the consumer economy is still in very good shape. The weakness here is mostly on the enterprise side of things. We've seen solid retail sales and discretionary spending numbers, some of the best in years. Job market is incredibly strong, best in 50 years. Wages are rising somewhat, although not so much as to be inflationary, so the Fed can cut rates. In short, the consumer has money to spend, and everybody needs to eat. But just like in every other sector, it pays to be picky with the restaurants, which is a prevailing theme in today's market. Now, some of the sit-down places like Dine Brands, think IHOP and Applebee's, Dave & Buster's, Darden, Brinker, they've all struggled to bring in customers of late. The fast food chains, on the other hand, have lines out the door because they appeal to more value-conscious consumers. That's why tonight we're going off the charts with the help of Bob Lang, the founder of ExplosiveOptions.net, as well as being the brilliant technician in the all-star team behind TheStreet.com's Trifecta Stocks newsletter. And he's also the author of Know Your Options. We're going to get a better read on three of his favorite fast food stocks, McDonald's, Chipotle, and Jack in the Box. McDonald's and Chipotle particularly intrigued me, so I'm going to spend some more time later in the show addressing why I like them long-term and short-term. Let's start with the daily chart of McDonald's, which got slammed today after J.P. Morgan published a pretty negative note predicting that the same-store sales would come in weaker than expected this quarter. In response, the stock plunged more than $5. This was really some of the major weakness in a Dow Jones average that was pretty terrible to begin with. The thing is, McDonald's is an incredibly well-run company. As I'll explain later in the show, I have enormous faith in the CEO, Steve Easterbrook. He has turned around the company with technology, with smarts, and the last quarter was excellent. So you might want to take this piece of research with a grain of salt. Now, just as important, Lang really likes what he's seeing in the chart. So we're doing chart and then fundies. Even though McDonald's got hit today, the stock, look at this, it's been on a major roll, all right? It's up more than 17% for 2019, not bad. So far, it's made a series of higher highs and higher lows. Lang points out that every time there's been a dip in this one, that dip has been a buy. And as you can see, every time. And this time, well, let's just see. Last month, McDonald's broke down below its floor of support. That's the 50-day moving average, which is the blue line, and currently at 214. And this is what often happens to stocks without a strong floor. Still, Lang thinks the pullback smells like an opportunity. The moving average convergence divergence, or the MACD line, which is right here, that's an important momentum indicator. It recently made what we call a bullish crossover. That's where the black line goes above the red one, and it's a pretty reliable signal that the stock is ready to head higher. There's been no degradation, that it still continues to work. Plus, the Williams R percentage oscillator, remember we have Larry Williams who did some of his stuff. This is his oscillator. Measures when a stock has gotten overbought or oversold. It now shows at last McDonald's in the oversold territory, which has always been a buy indicator. It's come down too far, too fast, due for a bounce. What if we want something less ambiguous? Okay, now here's my absolute favorite, Chipotle. Look at this thing. Remember, again, doing chart first and then later on fundies. This just exploded higher. It's up more than 90% year to date. And I think a lot of it is the brilliant leadership of CEO Brian Niccol and the fact that the company's finally gotten over all those health scare worries from a few years ago. Remember, American public thinks about 18 months and then they forget. It's just the way it is. It's that far in the rearview mirror. Chipotle remains one of the great growth stories out there. Company invested heavily in technology, get those lines moving faster, and process more customers. They've cleaned up the stores. They're rolling out lots of enticing new menu options, irresistible carne asada. Now, it's for the chart. Lang thinks it's got a lot going for it. Every time Chipotle pulls back to its 50-day moving average, the stock rebounds hard like it did last month. That's encouraging action. At the same time, there's the Ichimoku cloud. We've listened to this before. That's that green space in the chart. This is a technical tool that uses a bunch of moving averages to give you a read on the whole situation at a glance. When the Ichimoku cloud is green and expanding, like it is with Chipotle, that's a good sign. Right now, the stock is kind of going sideways, consolidating. It's got a monster gain from the summer. Remember, it's the best performing stock in the S&P. That's why Lang says it's a buy right here, something I agree with. And again, I will talk about that as the show progresses. Chipotle's got a ceiling of resistance at 850. And once it breaks out of that ceiling, well, let's just say there could be a lot more upside. Might take some time, though, before the breakout happens. Lang says it's worth the wait. I agree. Finally, now this is one that I'm not covering fundamentally because I'm not as bullish on it as Bob is, Jack in the Box. This is a company that competes directly against McDonald's. Jack's last quarter was spectacular. That's why the stock had a gigantic gap higher in August, okay? And that worries me that it had such a big gap. This thing's been on fire, though, ever since, making new high after new high. Every time the market's pulled back over the last couple of months, Jack in the Box has held up remarkably well. The stock's now above all of its key moving averages. The Ichimoku cloud is as bullish as it gets, and green and expanding. While Jack in the Box is an overbought territory, according to the Williams percentage R, all right, all the way up here, and that's what worries me, by the way. I think it's a little overbought. I don't want it to come down to that gap. This might be one of the embedded situations where there's so much demand for a stock that it gets overbought and stays there for weeks or months. I discussed the embedded in Get Rich Quick. It's the thing that really confounds me. It's a stock that's so overbought that it just stays overbought and wins. It's a positive sign. Now, look, for the past few weeks, Jack has been stuck in a pretty tight trading range. But this is what's known as an ascending triangle. See that? Okay. And that's where stock ceiling of resistance stays roughly flat, even as the floor of support keeps rising. Why does this matter? Because this is what's called a continuation pattern, where a stock pauses to consolidate after a big move and then resumes that move once it's ready. In other words, Jack in the Box might be marking time here before its next leg up. Lang says it's his favorite. Here's the bottom line. If you're looking for something that might be worth buying in this difficult market, and we have a difficult market, you could do a lot worse than the best-run fast food chains. The charts as interpreted by Bob Lang suggest that Jack in the Box and Chipotle have much more room to run, and McDonald's is worth snapping up in weakness. Later in the show, I'll lay out my view. Long-term, I like McDonald's. Chipotle should be bought now. I have to do more work on Jack in the Box because I just don't think this one is as easy as Bob says it is. Let's go to Pam in California. Please, Pam.
Hey, booyah, Jim.
Booyah, Pam.
First-time caller, long-time listener. Love it.
Thank you.
I have a question for you. Starbucks, SBUX, has been on a coffee high for the last year with gains around 75% and beating estimates for the last 8 quarters. So do you think they can sustain their global growth as they have been doing it in China? And should I stay caffeinated, get more caffeinated, or dump my stale
Wow,
coffee?
I like that. I like the way you're approaching that, Pam. I have to tell you, I've been waiting for Starbucks to come down in order to tell people, look, once again, it's ready to go. And you know what? It has come down a lot. And I believe that you should own the stock. It had a terrific quarter, a terrific year. Kevin Johnson's doing well. They're taking profits in the stock like they're taking profits in many others. And their cold brew during the afternoon is crushing it. Starbucks is a buy. John in Michigan. John.
Hey, Jim. Love the show. Just wanted to know what your thoughts were on Grubhub. It's being shorted by Jim Chanos.
Right.
And it's got a 200 EPS.
Well, here's the problem. Here's the problem with Grub. I own 2 restaurants. And I have to tell you that the war between Grubhub and this outfit DoorDash, Postmates, saw the big ads this weekend, maybe with Martha Stewart and Postmates. It is just too difficult for anyone to make money in that environment. The other 2 guys are private. They can lose all the money they want. So Grub, as much as it's very well run, and I happen to, and as everybody knows, because we've had management on, I think Matt Maloney's terrific. I think that business is too hard, even for someone as good as Matt. Always welcome on the show. All right, don't let the market pull a fast one. You need to get more selective about what you own, and the chart suggests Jack in the Box, Chipotle, and McDonald's can thrive in uncertain times. 2 out of 3, I agree with. Much more Mad Money Ed. I'm looking for a surge of profits in my exclusive with the CEO of Con Ed. Oh, boy, talk about something you can own. Then, on a hideous day, one of the hardest hit pockets is also one of the best long-term plays out there. So what should you do with some of these restaurant chains? And, of course, we'll take all your calls later, tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.